Hello, everybody, and welcome to this week's Middle Class Investor. This is Seth Martin, and it is April 25th, Saturday. And I want to thank everybody for coming in and watching the Middle Class Investor this week. We're watching a very choppy market, and certainly if you're a trader, it's a very challenging market. If you're just sitting on a 401k, you're probably not thinking about it too much. But we are getting very, very close to resistance, and might actually already be there, just depending on how you look at it. My guess is we have a little higher to go, probably early next week, and then the market will start turning down to make lower levels. Now, whether those will be lower lows, that remains to be seen. But it's definitely a narrowing market, and usually that's not great for people who are, in the market for a living, professional investors. And usually it portends some sort of coiling up where prices are going to break out one way or the other. So hopefully for all of you that have 401ks and IRAs out there, the price will break up to the upside, but we will watch it here and help you navigate it no matter which way it goes. So we're looking at the S&P 500 right here. You can see that we had an up week. It was a pretty good week, actually. We came right down to this level. I redrew this line, by the way, this orange line, and I connected it with this low and this low and this low. And you can see we almost got down to it and then reversed and went back up. I've got resistance drawn here at this blue box, so you can see that, there's just another, 6 or 8 points here till we get to this line, and then maybe another 10, to the top of the line. Now, I talked about last week that it could actually go to this line right here, because this is the line that connects the 2000 and 2007 highs. But I will say this: a lot of times when you have those types of things that everybody can see, the market will fool everybody and it won't go there just because, I guess. So I wouldn't count on it going there, but it certainly could go there, and could go there and a little bit above, actually. So anyway, it just we've got this tightening up. You can see the price action just kind of from one side of this thing to the other, and we've talked about this before, how the market tends to tighten. You can see it here as I draw it. You can see this distance, they'll get progressively shorter, and this basically, what you can glean from this is that opportunities for traders become fewer and fewer, and the market tends to want to either break out to the upside or break out to the downside. Now, this is a rising wedge, what we refer to as a rising wedge, and sometimes what you'll have happen is it'll break out to the upside and then turn around and break down to the downside. So, and usually if this breaks out to the downside, it goes all the way to the beginning of the pattern, which would be, this area right here, this box right here. So we're going to watch this area very closely wherever this begins to turn and come down. And if it breaks this channel area, then we're going to become a lot more defensive in the marketplace. You can see that area, that's 1800. I don't know what the percentage is on that. We could look at it real quick and see. If the market were to make that move, let's say from here to say right there, that's almost 16%. That would be 17% right there to the bottom of the box. So certainly nobody wants to lose 16% of their money. So we're going to be watching what happens very carefully. Now, the interest rate market it really didn't change much. All that was up this week slightly, and I'd drawn this line here around 1.8. I think it got as low as like 1.88 or something like that, and it could still come lower and actually make a new low here, a slight new low. It's just really hard to say right now. I mean, it's hard to me, I think what's going to happen, I mean, and this is just speculation. There's no way to know this, but I think what's going to happen is interest rates are going to take off, and then that's going to cause the market to fall a little bit. So that's what I'm looking to potentially happen. But again, there's really no way to know that. I mean, the RSI here is right in the middle, almost right in the middle of the range here. So, there's nothing you can glean from the internal indicators or just the price action itself. So, let's look at volatility before we get too far away from the S&P 500, and you can see that volatility continues to get lower, which is really unusual at these low levels, I think. But that's indicative of what you hear on TV. Everybody thinks there's plenty of upside left in the market, and the economy's strong, and all this stuff. This is very typical of low volatility. So it could actually go a little lower next week, and as the market moves a little higher. So, but at some point, volatility is going to expand, and if it breaks out of this downtrend, I think it's going to tell us that the trend is potentially trying to change. So we want to be very much on the lookout for that, and keep everybody out of trouble on that note. Let's look at the Euro US dollar. It continues to kind of chop around here below this level, kind of below the resistance area, or below the support area, and below this line that we had drawn that goes back way back, like almost to the beginning of the euro. So it looks like there's some value here that the market perceives, and I would say now that we've closed above this low here, this is here. Let's zoom in here and analyze this a little bit. If I can get a zoom in, let's do this. Let's see. There we go. So we have a low here, and we talked a little bit about this last week. We have a low here right at this dotted line, and then right here we have a slightly higher low. Oops. It's just ever so slightly higher. And then now we have another piece of evidence. This is a weekly chart, okay? We have a close above this high right here. So just looking at this, what I see, you can kind of see a pivot right here. There's a pivot right there. This pivot right here. And a lot of times, once you have this situation where you have a low, a higher low, and then a close, a lot of times the market, the next place it'll go to is kind of a DP area above the prior pivot. Okay. Now that doesn't mean it's going to stop and go lower. It just means that that's a place where it will stop, and it will go lower, but we don't know if it'll make a lower low. So a lot of times, think of it from a trading standpoint. If you're entering a trade here, your target price is right there. And then you would get out of that trade, because likely what's going to happen is it's going to pull back. Now, it could pull back to just say there and then go up, or it could pull back to there, can make a little wiggle up, and then make a lower low. You just don't know. So that's why these pivots, these previous pivots, are so key. I would say that if it pulls back here, makes a higher low again, and starts to take off, you could see the low end for the euro for at least the next area would be right in this area, right there. So let's say 117 or so. So I would say the short-term target for the euro is right here in this DP support area that I've got drawn. And that's right at this level here, which is roughly 111.25. So I think you can see the euro to go to 111.25, probably pull back, and then maybe come up to the 116 area. All right, let's move on to some of our country. Let's look at Germany. Germany continues to be, the best of a bad bunch, so to speak. And it's holding above this trend line, and we've got this level of resistance above. So we're expecting Germany. I would say if Germany closes above this week's high, so closes above this area right here, then it'll continue its march up toward this resistance area. On the chart here, I have to, I guess, pull back a little bit so you can see it. This is the resistance area that we're looking at. Japan, as you recall, Japan was in a sideways trend, broke out of that trend, and is now trying to get to the resistance area that we had drawn on the chart, and it looks like it's well on its way to that. So we had talked a lot about this. When the market trades sideways like this in a fairly tight range, and once it breaks out, the target is basically this distance on top of the breakout. So that's what gave us this blue box up here. Now it could actually go higher than this, but again, this is just a target. So what you're trying to do is you're trying to increase your level of confidence around what might happen. And notice I said might and not what will happen, because you don't really know what will happen. You just know what might happen if this happens. So if this breaks out of this range, then what might happen is Japan could go up into this next level of resistance. And as I said, it looks like it's well on its way to doing that. So for those of you who are interested in investing in Japan, maybe you increased some position in Japan when we were talking about this. Maybe not. I don't know. I didn't personally. That's only because I don't trade Japan. But a lot of people, are interested in these foreign markets, and some people think that's where the growth is. So, and I can't disagree with that. So, this is the United Kingdom, and we talked about we talked about back in here is that the United Kingdom it could pull back into a lower low at this support area here, or it would make its way up to this resistance. And I told you at the time that I thought it would probably make its way up into this resistance first, because this didn't look like a full pattern here, just this one move up and then down. A lot of times you get and what I mean by that is, if this is the prevailing trend, which it looks like it is, it looks like this is the main trend, this downtrend here. So in case you can't see, if this is the main trend, this downtrend here, then this can't be complete as a work off to this main trend. You have to have another up, okay? And that's why I was saying that I felt like we would see the UK get into this resistance area, and it looks like it is. And what we'll see next is we'll see if it does make it up there, we should see the UK pull down into this level of support below this pivot here, and then have a small correction from that, and then probably go lower from there. So the UK, in other words, if you're and I know we have somebody in the UK, if you're trading the UK, you want to look to get short here in this area, okay? Somewhere in this area, you want to look to start taking either getting out of a long position, getting out of your long trades and stepping on the sidelines, or getting out of your long trades and looking to reverse those to go short. So I hope that helps. If anybody needs any clarification on that, just comment in the YouTube channel, and I'll try to respond to those comments. Let's look now at, we'll come back to the SPY in a moment, but let's look at the dollar. So the US dollar, whoops, sorry about that. The US dollar continues, you can see here was the high. This week it was down a little bit, ever so slightly. And the US dollar is just kind of chopping around right in here. You know, to me it looks like it should pull back to this box and then lift higher, but I don't know, this pullback could be over. It looks pretty shallow to me, and this looks like a good wave 4 area. I don't know if you can see that or not, but this is what I'm talking about right here. This looks like a good wave 4 area, and if this is a wave 4 area, it should pull back into this space right here. So that's what I'm expecting to happen on the US dollar. You know, again, there's no way to actually know. We just have to place our bets based on what we see on the chart, and that's what I do here. So let's look at crude oil. We'll look at it in NinjaTrader. We've still got this box here on the chart. It's clawing its way in that direction. Looks like it's about done near term, potentially. So you could get a little chop down here and then could make its way back up to this box. But when you start seeing little bitty candles like this, you know, you might have one more high in here. When you start seeing little bitty candles like this, a lot of times it's foretelling the development of a new pivot and then the down move. I don't think oil is going to make a lower low on this down move. I think it probably will. Well, first of all, it'll probably go just slightly higher, and then you'll probably get some sort of correction looking thing like this, okay? And then you'll see oil move into this area. Could be as high as 75. You know, I've talked to you guys before about the midpoint of a large candle, and the midpoint of a large candle is right there. You can see this, here's a large candle. So I would say this would be a good place to expect oil to go to. And you can also tell by just listening to the media, you know, when you start getting into the area where it's going to turn, they'll start talking about could the falling prices in oil be over? This could be the end. Oil could be back to business as usual, and blah 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 blah. And that's usually about where it'll turn. So if you're I think you'll see something like this first. But if you're wanting to know where to get short oil, just kind of watch the price and then listen for what people start talking. People start getting more and more excited about the place where it turns and goes the other way. Okay, so if this is a wave 4, then obviously there's going to be a wave 5 down here below 44. So down here around 40, maybe 39, 38, something like that. So you know, just watch the price and then listen for the sentiment. You know, if the sentiment starts getting crazy, like that's it, oil's back on its way up, you know, then this is a good place probably to go short. That's some of that psychology at work. It happens in the media as well. So, all right, let's look at the DAX. We looked at Germany already, but we also have the DAX, and you know, we have a lot of strength here on the STF and MT Predictor, which generally means there's going to be, anytime you see a move like this with a real sharp candle back and the STF is still above the strength band, that means you're going to see a new high. That's been my experience. So look for the DAX to make a new high, you know, I don't know, up here somewhere. And then that's probably, you know, if we analyze that's probably a 5-wave move. And then look for the DAX to come right back to this area pretty quickly. But look for a new high first. So if you're in the DAX, even though you had a really sharp sell-off right here, you're probably okay. Let's look at bonds. Here are bonds. You know, this is the inverse of the interest rate, and I don't know, it's hard to say. It looks like maybe there's one more high left in bonds too. So we can maybe take a DP off of this pivot here. And that shows you that bonds could be, bonds could be, coming up into this area around 169 or so, 168, 169. But when this starts to fall, this is where you don't really want to be in bonds long term because it could fall pretty rapidly, almost like a crash. So be real careful if you're in long bond funds. The extra % or two that you might be trying to squeak out here is probably not worth the risk that you have to the downside, and that's why I've been focusing a lot on that. I just think that's a real blind spot for people and a real danger zone. We can look at the ES on a weekly. This is the future for the S&P 500, and you can see I took a DP off of this pivot here, and you can see we're already at resistance. That's why, and you can also see that the STF has been falling ever since December. We could be done here on the upside with the S&P 500, or there might be slight more upside. It might trade above this area and then reverse and come back. So next week early you might see the market higher, and then you might see it reverse and come back. That's likely what we're going to see, since it didn't reverse this week, really. That is about it. Let me go back to the SPY, because that's what we've been trading. Now, I was in Boston all week, so what I did, we had a really big up day on, I think it was Monday. It must have been Monday. So let me go to a daily chart and zoom in here. So what I did, let's see, Friday, Thursday, Wednesday, Tuesday, Monday. Yeah, so the market closed down here, okay, the previous week. Gapped up here on Monday, so you're already up a ton. It ran all the way up here, and I sold our SPY position here, or I bought it back. And then I was busy out of town in Boston, so I never got an opportunity to re-enter. So if I'd have just held it, it probably would have been better. We would have lost more value on our option, would have made more money. But I wasn't sure if we were going to get. You're never sure, right? So it looked to me like with such a big gap up, we could get a run back down here below this low, and then a move up. And if that were the case, I didn't want to be in the position. So I went ahead and bought the option back. I'll show you that real quick. And if next week, if it pulls back and it pulls back in a certain way that looks legitimate, then we'll try to buy it again. To get the right set of positions up here. Okay, so what I need is account statement, and then I need to go back so many days from here. It should be good enough. No, that's not good enough. Sorry about that. Let me back up some more. Why am I not seeing those trades? That's interesting. Well, I might not be able to show you. Maybe the history got wiped out somehow. Let's see, from 414, that should be back far enough. Let's go back further there too. Oh, I see. I'm going the wrong way. Sorry. All right, people. Sorry about that. Okay, so this 163 to 56, this was the trade that we had, I don't know, I guess that was the week before last. Is that right? So this was the first trade we did. So what you do is we sold We sold an SPY option at 163 and bought it back for 56. So we made, what is that, $1.03, okay? And then this past week, we sold, whoops, trying to put a box around that. We sold the SPY option for 263, and I bought it back for 171. We made, 92 cents. So those are both good trades. There's nothing wrong with that. There's nothing wrong with taking money off the table and just getting back in from a trading standpoint. So now these are more short-term trades. These are on scales of days, but you can do the same thing on the scales of weeks. So you get in 1 week, and then 3 weeks later, you get out because, or whatever, or 3 months later. It could even be 3 months later. So far we got two kind of winning trades, not big winners, but they're winners nonetheless. So I just wanted to show that to you, and it shows that we've made, I don't know, about $1,000. Here's that over here. See that where it says 1,000 right here? So we made a little money, nothing spectacular, $1,000. By the way, this is a paper money account. In case you guys think we're, I don't know, we're going to split this $1,000 or something. I don't know. But it's a paper money account. So Thinkorswim has a live trading account, and they have a paper money account. So all these charts and everything I show you are from the paper money account. And that way, if I draw on the chart, like my real money account, it doesn't mess up what I show you from week to week. That's the main reason I have it. So, okay, one last thing. I want to show you something that I thought was really important. And some of you may know or may have picked up on that I subscribe to Elliott Wave Financial Forecast and Elliott Wave Theorist, which costs about $30 a month. It's not a huge expense, but they report on things that you really don't hear anywhere else, and that's what I really like about it. And so the thing I want to point out is this right in here. Hopefully this is visible. It says credit is about to plunge, and it talks about this was actually reported on Zero Hedge, and any of you can go get subscribe to Zero Hedge. Zero Hedge is a blog, and they also write really interesting articles. Now there's a lot of articles in there. There's maybe 6 or 8 a day, maybe 10 a day. But if you don't sign up, give your email and a password, then you only get kind of the headline of the article and a little bit, maybe a few sentences of it. But if you give them your email and create a password, you can see the full article. So this is referencing an article in Zero Hedge, and it's reporting about this group called the National Association of Credit Management. And what this group does is they report on either the trend on businesses being accepted, their credit being accepted or denied. And so what you can see here, this is the financial crisis right here. You can see this is 2008, 2009. So you can see that businesses were more apt to get credit at the height of the financial crisis than they were last month. This is the spike here that you see down was last month. Now, we've talked about this before. Our financial system is a system that grows. So you've all heard of GDP. GDP only grows if credit is expanded. Okay? That's the only way that our financial system, our economy, grows by the way they measure it. Now, obviously you can have pockets of growth here and there, but this is not likely a good thing. It's likely to be, not so good. Certainly, if this trend continues, you're going to start hearing about it, how banks aren't loaning to each other, banks aren't loaning to businesses, and you're going to see credit contract. And if credit contracts, then GDP goes down, so on and so forth. So just something I wanted to point out. It's not something I've heard anywhere else, and I thought it was really interesting. You could probably Let's see, the Zero Hedge article was on April 13th. So you could probably type into Google Zero Hedge April 13th. What's the name of this organization? NACM Credit or something like that. And you could probably find the article that way. But anyway, I just thought it was pretty telling, and I didn't hear this anywhere else on the news. So pretty typical of the news. So anyway, that's it this week, everybody, for the Middle Class Investor. Really appreciate you coming in and spending the time with me. I'm hoping that you're telling your family and friends. I realize that a lot of people aren't interested in managing their own money or keeping an eye on it. At least they just kind of want to go to sleep. They just want it to go in and go to sleep. But what's going to happen? We've had a bull run here for about 7 years. We're going to have some sort of a bear market, and you really need to be on top of it during a bear market. You can put your money in and go to sleep during a bull market because there's just stock is continually accumulated, and the economy is it may be tepid, but it's still kind of growing or expanding. But during a bear market, all those conditions change, and this is where you lose big money. In fact, if you never take a short position ever, and all you do is avoid these bear markets, you'll be much, much wealthier at the time of retirement. And that's really what we're trying to do here, is just help everybody get to a place where you can retire one day and you're not financially stressed. Now, one of the things I just noticed here, and I can't believe I didn't notice this before, but and I'll say this real quick and then we'll leave you. I had this trend line drawn here. You can see it here, and we broke through it right here, and then we've been going back up. These are daily bars, by the way. So this is Friday. This is Thursday, Wednesday, Tuesday, Monday. So last Friday, we broke through this trend line here, and notice this week we never really got back above it. So that's interesting too. We might not get back above it. We might get right back to it and then actually fall. So I'll keep an eye on it, and we'll report here on the Middle Class Investor. In the meantime, thanks for coming in, everybody. Take care, and we'll see you next week. Bye.